Good afternoon. My name is Shillyboy Mutiba. Thank you so much. It's Wednesday, where I pick on question of the week. What caught my attention as I go through my journey of advising property investors about their wealth preservations and tax planning for that matter. So now, what I got, or rather, what caught my attention was with regard to asset transfer. Yes. Most property investors, as they start the journey of creating wealth, they'll typically buy properties in their personal names, right? Which is, it can be okay, right? Later on, they then realize that they reach issues of affordability because they reach a ceiling. You will all know that at some point you reach finance cap, right? As you're raising more bond with respective commercial banks. Or later on, they realize that they're sitting on equity. It can be a paid up property. It can be a property that have grown in market value. And then they decide that I want to unlock this particular property. Or for that matter, they want to do an estate planning. You might be sitting on a portfolio that is quite sizable and is in your personal name, and you realize, no, man, it's actually not ideal to be having so much wealth in my personal name. We've seen in the news, people are being kidnapped, kids are being kidnapped. The issue of privacy is becoming of paramount importance because you don't want to go around making sure that you show people that you've got wealth. Will you be doing that? No, of course you can't be doing that. So you shouldn't be doing that. And as a result, the privacy is important. Others are suing each other on social media. So you get into trouble, you say things about Shillyboy. Then I send the lawyers to you and then claim those couple of friends that are knowing very well that you've got money. Yes, you can be sued. But for that matter, if you're one of those adventurous entrepreneurs, guess what? Things can go south or west, who knows, depending on which is not your favorite position. But then what I'm saying basically is you could be sequestrated. And we all know that once you are sequestrated, what happens? You will then lose potentially what is in your personal name. So people then tend to typically say, listen, I don't want as much wealth in my personal name. I'll prefer to either be in a company or in a trust for that matter and create as many fireproof or firewalls as possible. Would you agree with me? Of course, then we're going to dwell into some of these potential scenarios. What could be the reason why someone will then wants to move their properties out of their personal name? Now, let's look at the issue of privacy. The issue of privacy is important. As I mentioned earlier on, that you might find that you are in a situation where you've got a wealth and you're exposed. You don't want this wealth to be sitting in your name. You're dealing with so many external parties. You feel that I need to create some sense of privacy. And we've seen over the years that the issues of people knowing that you've got wealth, you might get into that and their problems, right? So then people then tend to create trust because trust tend to have sense of privacy, that sense of secret, as long as your trust is not intact with the outside world. You get the situation where property investors will create what we call property trust, and then it's owned by it's owning companies underneath that. Such trust will typically be exposed because we'll deal a lot with external parties, be it attorneys, be it bankers, you know, you name them, be agents for that matter, as you sign in those OTPs and doing deals, or even for that matter, your business partners. Can you see that the sense of privacy kind of disappears? But then what then people do as they create more wealth, they then move and create family trust where they don't interact with the outside world. It's just one of those quiet, reserved wealth that you never even know anything about them. They even name, instead of naming it Shillyboy Trust or Mutiwa Trust, I know most of you like saving those issues of self-importance, and there's nothing wrong. But what I'm saying is that if you want to actually even have more privacy, you shouldn't be naming them after your names or after your same names, because it's quite easy to kind of make an ad and obviously align that with you. So that is a sense of why will then people want to move their properties into their family trust and things like that. That is precisely because they want to have that sense of privacy. Then it can be issues of wealth protection. What do I mean by issues of wealth protection? We are entrepreneurs in various forms, or for that matter, we are involved in high-risk professions, or you could be into trouble. What happens if you get sequestrated and you're sitting on a portfolio that is over 20 or 30 or 100 million? Can you see that you're more likely going to then be exposed? So then what then people do for the sake of wealth protection, they then do what you call restructuring, everything that is in their personal name, then make sure that they separate themselves. The ownership is do away with that, but they still retain some element of enjoyment. Those are some of the technical reasons. Now let's speak of issues of continuity, which is another segment. We all know you and I are gonna pass on. That is given, right? Now, what happens if I've got wealth? Say I've got a couple of properties in my personal name and I pass this on. Would you agree with me that there have to be a change of ownership? And the moment there's a change of ownership, it interrupts that continuity. I die and I live with my institutional memory. And this is why in most cases, kids struggle with maintaining the businesses from their parents. Because you find that a parent, for those who are familiar with general dealers, sole traders, if you grew up in townships and rural, they used to be the famous general dealers and sole traders. How they structured those deals or those businesses, they were in their personal names. They were just general dealers, but in a true sense of things, it was sole traders. The institutional memory is sitting with the founder. When the founder passes on, we always say, loosely speaking, in Sepedi say, basically they die with their wealth. And that in most cases has to do with that loss of continuity. In the main, because there's no centralized platform. The beauty with issues of companies formations and the trust formations when it comes to wealth, it's an opportunity to create a centralized management. And one of the best opportunities with that is the continuity. You pass on as a founder, we replace you as a CEO because you like titles, it's okay. We replace you and we find a replacement CEO and we move on. So there's no need for change of ownership because that particular company can be owned by shared trust or whatever, family trust, whichever way, where ultimately there's no need for a change of ownership upon the founders passing on. Would you agree with me? That is brilliant. So that is one of the reasons why you'll find someone sitting after having accumulated so much of asset portfolio and they sit and they come to Intergen and say, Shillyboy, I just want to move my wealth, whether being in business shares, whether being BE deals, whether being the asset portfolio that I've created, the properties that I've made. I want to restructure my affairs and move everything for that. That is commercial reasons. You can hear so far I haven't mentioned anything has to do with tax because restructuring has to make commercial sense before we even arrive at the issue of tax planning. And that is why it's so crucial. Because once it's beneficial and it's supported by commercial reasons, they are viable, tax will take care of itself, right? So now that is one of that. One of the reasons also is the issue of affordability. In the main, people tend to buy properties in their personal name. It's easy process. You'll agree with me. The figure documents and the requirements of buying properties using a personal name as compared to trust and the companies, there's quite additional documents, and rightfully so because those are separate personnel or entities or taxpayers for that matter that from the figure point of view, on behalf of the banks, they need to satisfy themselves that everything is compliant. Who's the ultimate beneficial owner? You will agree with me. So, which is understandable, right? Now, then people then tend to say, listen, you know what? I don't want to complicate my life. I want to buy property using my personal name, which is fine. But then later on, they realize I had an affordability room of about 5 million as an example. They reach the ceiling, right? And then they come say, listen, Shillyboy, I can't even buy more properties. I just want to move this, consolidate everything, move this into a company or a trust so that I can be free to buy more properties. Of course, by doing those, so something that I need to warn you is the fact that one way or another, someone has to stand for surety, because those companies might not be trading, might be trading. You still need to stand for surety. But the beauty is that when you stand for surety, will you agree with me that you're not listed in credit bureau? So in a true sense of things, that bond is not reflecting your personal, which means you still have a room, as long as the banks don't consider the issue of affordability. Some they will do, some they will say, okay, it's not the same as you having the obligation, especially if there's enough value in that particular company that you're moving everything into, right? Then you're free to buy more properties. And that is what we call an asset or a financing optimization. So why not consider things like that? So that is one of the reasons why people do that, which is issue of affordability. Now, something that is more closer to that is an issue of equity realization. Equity realization comes in when you find that someone has been paying the property and is sitting there. And they sit back and say, listen, I can actually do more with the money that is sitting there. And I mean, will you agree with me? How many properties in the township, those that will know the issue of title deed is a very, very sensitive thing in the country. But how many properties, those that have a title deed, have not actually passed on to the owners after other owners, the original owner having passed on? That is another debate or another issue that we need to unpack. But that's an equity that is not being leveraged, that is sitting there. So now take that as an example also, someone who's sitting on a property that is paid up or is halfway or it has increased in a market value. Then that is money that is sitting there. Some people might say, listen, Shillyboy, I've got these opportunities that I don't want anymore to buy in my personal name. I want to finance a new investment structure. I've listened to you regarding the tax planning. I've listened to you on the issue of continuity. I've listened to you with regard to the issue of privacy. I don't want to be kidnapped. I don't want my kids to be kidnapped. I don't want to be sued. I don't want to, it's a situation should I be sequestrated and I lose everything that is in my personal name. Would you agree with me on that? Right. Now, then they come and say, listen, I want to realize this equity and then support this new investment structure that has a central position, has central management. Maybe you can even hire me as one of those non-exec directors there. Who knows if you're sitting on a $500 million property portfolio. Now, the question then comes in and say, okay, then let's then move all these things into and realize the equity. You're sitting on the money. So which means that there will be some sort of a company buying a property from you and then you being given money by whoever the bank is in this case, from having the company bought the properties from you, right? You're sitting on the money. Now the question is, how do we then take that money into the structure? We need to be mindful of tax issues. Remember, you can't just move money into the company. I know most of you guys are sitting on deposit 200,000 that is sitting in the companies. You need to speak to me because there's a huge tax implications in that. So we then need to look at the issue of taxes to say, if we're going to put in 500,000 in this structure, what are the tax implications and how do we record these things on an annual basis? But the fact of the matter is that you realize the equity. And on top of that, you're building a new structure that satisfied everything else that I've spoken about to now, right? Would you agree with me? So which is good, which is great. So that is equity issue of realization. Now, Let's give an example of growth, guys. The reality is that we always speak about intergenerational wealth, and where you're all saying, I'm working hard, I'm in business, some of you are taking early flights, going to see properties, and you are doing that for intergenerational wealth. I think it's a trendy word. It's a feel-good word, and there's nothing wrong with it. But we need to ask ourselves the question of, how are you actually going to pass on the wealth to the next generation? What systems are in place that are not going to dilute the power of one rand? And I'll give you an example. If I've got 4 kids, okay, let's simplify this. I've got 2 kids and I've got 1 rand as my wealth, as an example. I want to split this into 2 different bloodlines. Remember, when you've got 2 kids, they're going to marry different bloodlines here, which means that you're potentially having different bloodlines as they go. You created this wealth. It's quite difficult, historically, it's quite difficult to retain wealth in one family structure when there's an entry or there's a new bloodlines coming in. You need to factor that in. And there's strategy that can be used. How do you ensure that the wealth remain 1 rand? You don't split the 1 rand in a true sense of legality, but in terms of enjoyment, you split this 1 rand. Yes, because you don't want a situation where you're giving each child 50 cents. Because you'll agree with me, 250 cents versus 1 rand is not the same. If you understand the method of concentration of money. Now, we need to structure your wealth in such a way that we don't lose the value of 1 rand. But we equally so need to be mindful of different bloodlines. That's structuring. And it has to do with wealth. Now, this is why various products comes in where we centralize family wealth. And we need to think of tax planning on how we're going to distribute the money to the different bloodlines. And this is where the likes of trust, giving birth to other trusts, comes in. Now, but then we need certain clauses, certain tax provisions to ensure that there's an efficient flow of money. That is wealth distribution. And that's why you'll find people saying, listen, time is moving. I want to move my wealth into this structure. From there, I need the beneficiaries from different bloodlines with the terms. Because you might find, let me give you an example. Let's say you've got this sustainable business that BE requirements are crucial for you to get more business, which means that we need to be mindful of what is included in the trust deed that owns the shares of that business. If it happens, for instance, that your child marries someone that does not benefit us in terms of BE points, would you agree with me that there's a potential dilution of wealth because that business underneath will potentially not get business? The same thing with properties. You want to be mindful that you're protecting and centralizing wealth in such a way that it satisfies. You might want your son-in-law, your daughter-in-law. I mean, those are your personal preferences, that they don't benefit from the wealth you created. It doesn't form part of joint estate. Should they fall in love and they want to marry incognito property? To others, there's nothing wrong, by the way. You want to make sure that such is taken into account. Hence, the birth of different types of trust underneath the main trust is crucial. And that results with making sure that you ring-fence certain things. And that is wealth distributions. Because you need to plan how you're going to execute. When are your heirs going to benefit from your wealth? It's crucial. Now, the last thing, can you see now the issue of tax now is the last thing when you're structuring. But at the end of the day, once all those commercial terms I spoke about, they come back, they speak to an estate duty or tax planning for that matter. We all know that once you pass this on, everything that is in your personal name will be subjected to things like estate duties, will be subjected to things like capital gain tax, potentially. Of course, there's a movement and things like that. But that should be your last resort. You shouldn't move things just purely because you are running away from tax, because you're more likely going to do things the wrong way. So your commercial reasons should outweigh the tax. Tax should be by the way thing. Yes, you can take advantage of where you are allowed, but always look for things to be more sustainable. Look for commercial reasons. Then you're more likely going to raise funds. You know, when you're subjected to audit at SARS, it's going to be much easier to justify. You know, things like that. You know, the issue of substance over form comes into play. Then we can justify why you are doing that because it makes commercial sense. You know, even the agreement, they're above board, they're at arm's length, you know, those type of things. That's why even when you're going to move the properties, it needs to be at arm's length, which means that at market value, because those are some of the requirements. So if those things make sense from that commercial point of view, we're not going to have problems with SARS. So some of the benefits of then moving that, it's, by the way, tax, where you can save on things like estate duties, you can save on executors' fees, you can save on things like capital gain tax, potentially if you pass this on, you know, all those type of things that you know that then you will reduce all these things that is in your personal name. So that is basically the question of the week. And I felt I needed to summarize, and because it's always a challenge for people not knowing why they'll move the properties out of their personal name. I'm more than happy to have a discussion with you. You know where to reach me. You can WhatsApp me, you can send me messages, you can do everything to get a hold of me. And then we can have a conversation and look at your structure and look at your portfolio, look at your wealth, whatever the type of business you're involved in. Let's sit down and analyze it. At the end of the day, the wealth has to pass on to the next generation. And yeah, thank you so much. I'll have a conversation with you next week, Wednesday, 5 p.m. Yes. And yeah, for those who might be watching from YouTube and podcast, thank you so much. Also, I appreciate you. Yeah, let's keep talking, and good luck with creating wealth. I'm here for your assistance when it comes to tax planning. Yeah, good luck. Cheers. Bye.